Hey there, hope all is well. Back at you today with some more RTD News updates. And as you can tell from today's title, Derivatives, the Financial Weapons of Mass Destruction, I'm going to be covering a topic that doesn't really get much recognition as far as the magnitude of how serious these financial instruments are. And my goal is to share a couple articles with you today to kind of simplify it so that everyone can begin understanding the importance of knowing about derivatives. And so I actually have a quote from Mr. Warren Buffett to give you an idea of how serious it is. And he's quoted as saying, "Derivatives are financial weapons of mass destruction, carrying dangers that, while not latent, are potentially lethal." And so once again, once you have an investor that's highly respected all over the planet mentioning that derivatives are lethal, it's definitely something worth checking into. And I also want to bring up to your attention, former guest of Rethinking a Dollar, Michael T. Snyder, wrote a very detailed piece that we're going to be covering today in the articles, of which he goes into some of the details as to how these banks over my shoulder here are by far the most dangerous financial institutions on the planet. So let's get into today's articles. So as I mentioned, I have a few articles here that I want to share with you and just scan through them briefly. And as always, if you're interested in finding out more, you can just scroll below and actually read the articles for yourself to get more details. And so the first article here is from The Telegraph, and it's from earlier this month, and it's in regards to what Warren Buffett was quoted as saying in regards to the whole time bomb aspect. And it says here, Warren Buffett issues a fresh warning about derivatives time bomb. And then the next article here is a little bit of an older article, but it's once again about Warren Buffett and derivatives. And it says Warren Buffett paid $195 million to get rid of some of the financial weapons of mass destruction. And this was as of 2016 in August summer. And the next article here has to do with the most recent blog from Michael T. Snyder that I mentioned about earlier. And it's entitled Financial Weapons of Mass Destruction. The top 25 U.S. banks have $222 trillion of exposure to derivatives. So it's going to be quite interesting there. Next one here is from Forbes, and this is as of a couple years ago. This is actually 2013, but yet it gives you an idea of what derivatives is and how it entangles in our whole monetary system. And it says big banks and derivatives and why another financial crisis is inevitable. And then here is from Investment Watch blog, and this is from 2011, and it says the root cause of the 2008 financial meltdown was derivatives. And then the next one here, and the very last one, is basically just a PDF file that I found from the National Center for Policy Analysis, and it's entitled The Role of Derivatives in the Financial Crisis. And it gives a couple graphs here that kind of breaks it down even further about credit default swaps and all types of, technical things that you might want to take a look at as well. So let's just scroll back to the very first one. I wanted to be brief on this, but yet give you an overall outlay of what this is about and why you should definitely be concerned and to keep an eye on this matter. So the very first one here has Warren Buffett surrounded by a lot of people. And of course, whenever Warren Buffett speaks, it tends to get everyone's attention because this guy knows what he's doing. And so here, just give you an idea what's going on. It says Warren Buffett, one of the world's most storied investors, has issued a fresh warning that the complex derivatives lurking on the bank's balance sheets are a potential time bomb that could explode in times of stress. It says the sage of Oklahoma told the annual meeting of his company, Berkshire Hathaway, that while he still believes in holding shares in financial firms such as Bank of America, the sector continues to build derivatives that could create dangerous jolts in the value that would exasperate a major shock. And then scroll down a little bit further, it's quoting him saying, some of these things get so complicated that they're very hard to evaluate, emphasizing a warning he gave last summer when he described derivatives as weapons of mass destruction. Mr. Buffett said a major event such as a cyber attack that could shut down the financial markets would trigger enormous gaps in things you thought might be protected by collateral. So things such as investments and retirement portfolios and all those things that people believe are there waiting on them. It says, I regard very large derivative positions as dangerous. We inherited a modest-sized position at Berkshire's reinsurance vehicle, John Ray, in a benign market, and we lost about $400 million just trying to unwind it with no pressure on us whatsoever. So basically just saying that he's concerned, and it's something that definitely his company keeps an eye on, being that they've made money in the past. And he mentioned one of these big banks over my shoulder. If anything happens as far as any type of glitch, there could be problems where those tools or financial instruments may be in trouble. So more if you're interested in reading down below. Next one here is from Business Insider, and it says Warren Buffett paid $195 million to get rid of some of his financial weapons of mass destruction. And this is, as I mentioned last summer. It says Warren Buffett has dumped a whole lot of derivatives, Buffett, the CEO of Berkshire Hathaway, paid $195 million to end its contract on derivatives, protecting against the default of some bonds, according to a filing with the U.S. Securities and Exchange Commission. And then it shows a picture here of a nuclear explosion going off. It says Buffett's use of derivatives has always been begrudging. The famed investor has reportedly called the products a financial weapon of mass destruction and a time bomb in the markets. It says according to the filing from Berkshire Hathaway, the contracts were covering losses for investors on municipal bonds. It says essentially Berkshire was acting as an insurer for the investors in certain municipalities' bonds if they were to default. It says in July, Buffett paid $195 million to an unnamed counterparty in order to close the policy. So when Warren Buffett is, rethinking some things and selling off some things because of his concern for this ticking time bomb, as he puts it, is definitely something worth noting. So more information below if you're interested in reading about it. But yeah, just wanted to highlight the fact that one of the most famous investors on the planet is talking about the seriousness of these derivatives. And so now we're about to get into something a little bit more detailed from Michael Snyder from the Economic Collapse blog that came out about a week ago. And it's entitled Financial Weapons of Mass Destruction. The top 25 U.S. banks have $222 trillion of exposure to derivatives. And so he's going to go through some of the statistics and actual numbers in regards to these banks that's over my shoulder, as well as give you an idea of what derivatives are and from a simple form so that you can understand it a lot easier than, the technical people might want to make it seem like it's, about. It says the recklessness of the top big to fail banks almost doomed them last time around, but apparently they haven't learned from their past mistakes. Today, the 2025 top U.S. banks have $222 trillion of exposure to derivatives. In other words, the exposure that these banks have to derivative contracts is approximately equivalent to the gross domestic product of the United States 12 times over. As long as stock prices continue to rise, the U.S. economy stays fairly stable. These extremely risky financial weapons of mass destruction will probably not take down our financial system, but someday another major crisis will inevitably happen, and when that day arrives, the devastation that these financial instruments will cause will be absolutely unprecedented. And so just to scroll down and give you an idea of what's going on here. It says, during the financial crisis of 2008, derivatives played a staring role, and the U.S. taxpayers were forced to step in and bail out companies such as AIG that were on the verge of collapse because the risk that they took were just too great. And then here it goes down and give you an actual breakdown of some of the figures that these banks over my shoulder are kind of positioned with. And it says total assets for Citigroup is $1.792 trillion. It says so basically slightly less than 1.8 trillion. But yet it's exposed to $47 trillion worth of derivatives. So if you look at the amount of assets they have, 1.8 roughly, and you look at their exposure to or what they're on the hook for if something goes wrong, $47 trillion, there's no way on this green earth that they can cover that loss or the obligation of paying back or being involved in paying all that off. And so the next one here is from Jpmorgan Chase, and it says they have about 2.4 trillion or $2.5 trillion in assets total. And these assets, as I might mention, are deposits and investment vehicles that people invest their money into that they're so-called receiving some type of interest on, but not really receiving much. But yet, they're basically gambling with, their depositors' money. So if you're banking at one of these locations, then your money is tied into these derivatives. So it would lead me to think that if something goes wrong with these weapons of mass destruction, you may not necessarily receive what you think the banks are holding on your behalf. So just something to consider. So the next one here is from Goldman Sachs. They're at a little less than $1 trillion, but yet they're entangled in $41 trillion worth of derivatives. Bank of America, it has $2.1 trillion in deposits and assets total on their books, but they're obligated for $33 trillion. Morgan Stanley here has less than $1 trillion of assets, but they have $28 trillion worth of derivatives that they're exposed to. It said Wells Fargo has 1.9, but they have $7 trillion. So it says collectively, the top banks have a total of $22 trillion of exposure to derivatives. So definitely something, it's quite alarming. And it says if you are all new to this, you might be wondering what a derivative actually is. So he's about to go into actually explaining what it is. It says when you buy a stock, you are purchasing an ownership interest in a company. And when you buy a bond, you are purchasing the debt of a company. But when you buy a derivative, you are not actually getting anything tangible. It says instead you are simply making a side bet about whether something will or will not happen in the future. The side bets can be extraordinarily complex, but at their core, they are basically just wagers. The following is a pretty good demonstration of a derivative from Investopedia. And so it gives you a definition here from Investopedia. It says a derivative is a security with a price that is dependent upon the derived from one or more underlying assets. The derivative itself is a contract between two or more parties based upon the assets of assets. Its value is determined by fluctuations in underlying assets. The most common underlying assets include stocks, bonds, commodities, currencies, interest rates, and market indexes. So basically, to sum it all up, derivatives are bets between financial institutions on something as to future outcome of it. So for example, if you have as it says here, interest rates, so they basically can make a bet saying the interest rates can be given at a certain figure won't go up to a higher figure within this stretch of time, and then they can just put some money on that type of thing. And basically that's a derivative. So there's money, there's, as you see, trillions of dollars on side bets amongst these financial institutions, kind of like in the form of basically, a big gambling casino. They're basically gambling with their depositors' money, saying that, they're going to make X, Y dollars, and then basically, not necessarily give you any cut off of that because they're banking amongst themselves or trading amongst themselves. So he goes on to give you more information from Jim Rickards, his quotes, as well as quoting Warren Buffett here. But if you're interested, you can scroll down below and read that for yourself. I want to keep moving on. So the next article here is from Forbes. It says, big banks and derivatives, why another financial crisis is inevitable. So here, this one, as I mentioned, is a little bit older, but it goes back and gives you some history. And so it's definitely something worth reading just to get an idea of how, over the last couple of years since the Great Recession, there's been a lot of reports that different commentators have kind of shared their thoughts on it. And I thought this was definitely a good piece here that goes more into the banking sector. If you're interested in reading it, just feel free to scroll down below. And then the next one here says the root cause of the 2008 financial meltdown, derivatives, from Investment Watch blog. And so this one here kind of lays out a nice framework of the credit default swaps, as he put here, and the whole mortgage crisis. And he goes into great detail in regards to the political aspects of it. And then gives you some figures here as far as the actual rate at that time, or the amount at that time from commercial banks being $234 trillion. So it's a quite massive amount of money just being mentioned in with these figures here, which unless you're actually are paying close attention to it, it can be quite overwhelming. And so just to score down a little bit more, he gives you more figures, and this is from years and years ago. So since then, they've all increased. So it gives you the breakdown of all the banks for the most part and their exposure to derivatives. And then the next one here is, as I mentioned, the roles of derivatives in a PDF form. So definitely some good reading material that kind of paints a picture of how the whole 2008 crisis unfolded. But I kind of want to just end this with the idea of how this relates to rethinking a dollar. So basically, the whole idea in understanding rethinking a dollar is to understanding monetary matters. And so being that our monetary system is based upon and supporting the banking system, from 2008 when the whole bailout situation happened, where all the financial institutions over my shoulder receive a massive amounts of bailouts in regards to basically just our government putting taxpayers on the hook for supplying liquidity back into these banks, being that they were in the process of having to cover some of these derivatives as they were becoming due. And in order to do so, they basically, borrowed money or, got it from our government in order for them to continue to do what they do and stay in business. But the problem was never solved. And so what that's done is made them even more lethal and more dangerous as far as just the holding other people's money and doing banking for people in general. And so they've gotten actually too big to fail times 10 since 2008 financial crisis, which means that nothing's been fixed and everything has been covered up. And this whole derivatives aspect is just it's kind of like the foundation of how all this is, and why all this is kind of been maintained because of greed and just the illusion of a fair monetary system. The banks have exposed the globe to massive amounts of debt. As far as consumer debt, this derivative debt, we have subprime debt, we have the auto loan, we have all this debt that is tied into these derivatives. So they're making side bets amongst themselves on whether or not these bets or not these debts will be paid, and if rates will go up and go down. And so they're making bets among themselves with the depositors' money, which means if you're banking in these institutions, and even the smaller banks as well, they're dependent upon liquidity from these big banks. So it's all tied together. And how that relates to the dollar aspect is that we are dependent upon Federal Reserve notes. And Federal Reserve notes are what's in deposit at these banks. And so as Warren Buffett mentioned, and as Michael T. Snyder kind of pointed at, is that if things go wrong, then that means there's going to be a question as to the ability for you and I to continue to use the Federal Reserve notes for day-to-day transactions. And so that means the Federal Reserve note and our United States government is going to have to respond in some way. And more than likely, that's going to mean increasing the money supply and bailing out or bailing in these banks so that they can continue to operate. Because at the end of the day, it looks like, and it appears to be, that the most important thing in our monetary realm, as well as our financial realm, is to keep these banks in operation. Because if they go, our entire economy and monetary system on the globe is going down. So just want to share some thoughts with you on these financial weapons of mass destruction. I think if Warren Buffett is talking about it or has talked about it, then it's definitely something worth looking into more for yourself. And then also taking a look at these articles just so you can become more aware on what they're about. And so, of course, I'm not a technical guy, so I can't go into great detail about it. But my goal is to basically be the middleman between the mainstream news and the alternative media news, to share with you some information that I believe can be of use to you if you dive into it further, just to understand how all this ties together. So once again, thanks for tuning in. I hope you enjoyed this. Also, leave me a comment below. I could be completely off my rockers or could be wrong. Feel free to let me know. I'm all about learning new things myself. And if you're new to RTD, click the subscribe button for more RTD news updates as well as interviews. Enjoy your day. Thanks.